Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome to the Greedy Trader channel. Well, I'm not exactly greedy, as most of you old watchers of the channel will testify. I have the most conservative approach to trading. It's just a nice parody idea from the Gordon Gekko mantra. There are only two kinds of traders, the greedy ones and the fearful ones.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Those of you who are new to the channel, this is where you can learn how to really trade like a professional. Every video I make is packed with real examples with before and after scenarios, so you can see that it is simply a question of sticking with the plan and not changing it because you're having an emotional meltdown. In this video, I'm going to show you how to become a consistent trader. Consistency in execution and checklisting will eventually result in profitability. Trading is a probabilistic game and does require a consistent large number of repeatable trade executions. Did you know the worst repeatable strategy is a coin flip, and that will yield an expectancy of 1, essentially 50-50. If the payoff was simply $2 for every dollar lost, then everyone would be profitable. The fact is, most traders fail to develop consistent, reasonable steps. This, I find, is how I get many traders to become profitable. I know, easier said than done. In this video, I'm going to attempt to show you how you can become consistent using my second trifecta model, analyzing the volume print. Let's dive in. Okay guys, so I'm going to dive straight in. We're going to start talking about how we use the second trifecta to get consistent. Now, of course, I know for those of you who followed my videos, this is becoming very, very familiar. What I'm trying to achieve here is to make sure that everybody can be very consistent with execution and strategy going forward. Now, we know there is a massive temptation in the trading space to follow different strategies, to follow different people who are telling you different things, and all eventually leading to profitability. Now, we know that profitability can be easy to achieve, but it can also be very difficult to achieve. So it's, of course, a little bit paradoxical, but the fact is that is the case. It's easy to achieve because if you have the discipline to do repeated steps all the time with very consistent risk-reward scenarios, then you're probably going to be profitable. On the other hand, if you don't do this and you follow a multiple strategy approach, and often you can't repeat this consistently and you don't have consistent R factors, then you are probably not going to be profitable. And the reason for this is actually really, really simple, and it's because even the worst strategy tends to yield 50-50 expectancy, right? So you got an expectancy of 1. Best strategies often have an expectancy of 1.5 to 2. So if you're consistent in repeating a series of steps and you can push those, you can push yourself into the outlier territory, then you're going to be profitable. There's actually no question about it. But I think that is normally the challenge, is how do I get myself into the place where I'm consistent? That's what most traders are asking. What do I need to do? What steps do I need to follow? So as difficult as it can be from a psychological point of view, I'm going to do my best in this video, in this single video, to show you how you can be consistent using my second trifecta method, which I've spoken about in several other videos. So if you have not seen any of those videos, just link to one of the playlists or link to the mentorship program and you will learn all about this. But moving on, what's the first thing I tend to do if I am going to consider using a volume analysis approach, right? Which is my second trifecta, which is vol. So for those of you, just as a rehash, again, I'm not going to spend too much time on it, but as a rehash, I got my first trifecta, which is liquidity, my second, the volume, and my third trifecta, time. And of course, in my most recent video, I talked about my fourth echelon of trading, which is macro. But we're not going to get into that right now. Right, so for me, these are the 4 steps that categorize a good trade execution. I look at all 4 of these things before making a decision. So my first trifecta, I need to understand the liquidity part of the equation. I need to understand where the demand and supply is, which is the volume part of the equation. And I need to trade at times where my trades are going to be most efficient. And that's the time part of the equation. Obviously, I need a bias, whether that is a bullish or bearish bias. I need to have that. And I do that by taking a 4th echelon approach where I look at the macro. So it's pretty simple. I try not to overcomplicate it. I take this approach into every asset I trade. It doesn't matter whether that's on equities, futures, or it's spot markets like the FX market. All right, so step 1, what do I do? First is we want to map out the demand and supply. Because in this video, we're talking primarily about volume. I might touch on the first trifecta every now and again, but I'm not going to spend a lot of time on it. I'm going to focus primarily on volume. So if you find this video boring or not to your liking, then check out the other videos that talk about this more completely. If you are behind as well and you feel like you're not understanding what I'm trying to say, then look at those other videos as well. But I guarantee you guys, this is going to help you if you stick around. I know these days attention spans, it's difficult with the TikToks and the Instagrams and so on. You know, it's a survival of the feed. But if you follow this video and you stick with it, I guarantee you're going to get some value from this. Who knows, you might even start to pull trades out of the bag. I know some of you are already doing that. This is evident on my Discord server. If I've left a link below, it is a free Discord server, so there's essentially nothing for you to purchase there. It's just a way for you to reach out to me, or if you wanted to look at some of the ways I trade, some of the things I do, and you want to get that insider kind of knowledge base, then you can follow me on Discord. Right, so the first thing I want to do is map out the demand and supply, and that's actually really easy to do. So the first thing is when we open a session, so I'm going to start back here where we first had the initial demand and supply mapping. And what I would like all of you to do is to pay close attention to what happens at these levels through different days as we map this out, right? So in other words, we're developing a kind of manual heat map. This is not an automated indicator that I've put together. I could do that, but I'm not wanting to do that because it really keeps me in the zone. When I map this out, I remember these levels and I'm very prepared to execute against them, as opposed to have some kind of robot do it for me. It'll be way easier, of course, but it takes me only a few minutes, so I don't really feel I need that. However, I know some of you have technical skill, so if you want to bring that to the table in order to develop this into some kind of trading indicator or algorithm, then you're more than welcome to. Okay, so step 1, right? So I'm going to zoom the picture in so we get a very big wide picture so we can see what's going on. Right, so if you notice, we got the Asia session, which is the time part of our trifecta, which is Asia. It's very low liquidity, but it really gives us some really interesting information in terms of what the earliest traders in the market have been thinking, which is the guys in Asia. And then we cycle into Europe, where we spend most of the time. Now this is cable, of course. We spend most of the time driving the asset back and forth, at least setting a range. And then finally, we drive into the US session, which is going to be the most liquid session, of course. And the times we trade is going to be crucial. We have several different openings. We have the NASDAQ, we have the New York Open, and we also have the Chicago Open for the Mercantile Exchange, of course, and that deals with all the big futures. And that's where the pit sessions are as well. So it's actually a really important session. So we got those opening up, and some of those will include FX futures. So of course we need to pay attention to that. We also have FX options as well. Right, so it's a really important session. So the US session by far is the most important session, and if you're making decisions in this session, you're going to have a higher chance, of course, of profitability. That is the time trifecta. Okay, so take a step back. Let's focus on the European Open. So we're going to start initially with the Asian Open, where we can clearly see, and this is where it comes to mapping the demand and supply. So the first thing we want to do is we want to map out demand and supply a little bit more dynamically. So if you're awake in Asia, which I'm not, but let's say you are, we got 2 a.m., which is when we have all those interbank settlements. Right, so that 2 a.m., 3 a.m. in the morning, we start to see there is a degree of a picture. So initially we can see we're coming from a very low base, first part of the trifecta liquidity. So we've swept for that underside liquidity. The reason we do that is because there's going to be stops there. So the bigger traders tend to go for those stops where they can get cheaper prices. So for example, down here, there'll be sell stops. Those sell stops will trigger and they become buy orders. In other words, because obviously someone sold to someone else, and then the market goes off those orders. So that's typically just searching for liquidity. Nothing sinister about it, it's just how the market works. So we can see that we've already traded that liquidity low, and we can see there's an awful lot of volume, and this was at 6 in the evening, so it was a late session, and then we had a liquidity sweep. We now move upwards through Asia, and we can start to see a building of demand against what we've just seen. So generally now we've got kind of a long bias because we're coming into an early session. We can see volume is building, and that's evident at 2 a.m. So we can see that the demand side was 24.25, and then we start to close above, which suggests that there were buyers in the market. We start to see this market dip lower on significantly low volume, which is telling us that of course this is weak supply and we could touch out and hit demand at any point. Right, we can see we had a liquidity low, so this entire third, so what we would then do, this entire third, right, so if we look at this level here, would be considered reasonably demand. So that's effectively what we're looking at. So that tells us that even if we see the market going lower, we should be positioning for the buy side, okay? Because again, unless we were to take out this volume or this demand, then it's not likely that we're going to go lower. So this is kind of typically how we build a volume map, right? So what we're doing is we're kind of building a map of the volume, how the demand and supply picture is shaping up. So because we're doing that dynamically in Asia, right, so we'll have volume here, and then ultimately we'll have what looks like demand here, right? So that will be kind of our demand zone. So we broke below that, that's fine. As we come into London, it's 6 a.m, so it's pretty early. And by the time the London session actually kicks in at 7, we can see that we were heading straight back up and reclaiming this demand area. So that's the first thing that sticks out to us. So as you're waking up early and you're looking at the market 6 a.m. and you're coming into 7, you're now visiting the time part of the trifecta. We're coming into a liquid session, which is London, and we can clearly see that the market is showing a propensity to go higher after we'd seen a liquidity sweep in the late evening of prior day, and then we can see demand developing in Asia. So you can quickly see that it's not very difficult to start to conclude that there's a higher probability that the market's going to go higher, right? Trading is a probabilistic game, so we don't necessarily always know if we're going to be right. But what we do know is that if we keep repeating this behavior, which is based on order flow analysis, then I should get some pretty good trades, right? Because what it's allowing me to do is to do my risk rewarding a lot better. So now that I can see that we're breaking the prior candle high, which was the 6 a.m. high, we're moving to the upside, we're reclaiming the Asia demand, then it would change my perspective. Then I might want to be a buyer, and that would look like me getting long here, for example, and then me accommodating risk below the 6 a.m. low, right? Which gives me a really good chance that even if we were just to reclaim the prior day high, right, which is what we did in pretty much one session, then I'm going to be significantly profitable because it will allow me to liquidate into what was the supply, which we can see here from the prior day, right, which is where I'd expect the market to stop, and then I'll just cover that trade or liquidate that trade, as the case may be. So that's obviously an example of typically how we would start to build that picture and tackle that execution more dynamically. So let's back up a little bit, right? So I'm just gonna leave this here because this was like a very crucial part of our bias for the intraday or our decision making, and we can see where our likely execution was going to be. Now let's say of course that you missed this execution and you would say you missed it, right? For whatever reason, you were not prepared to trade, you just missed it. Now the next step will be, we've gone up, do we want to be a buyer? Question to you guys watching. Well, for me, the answer is no. I don't want to buy at higher prices. Reason for that is we call that paying up in the business. You don't want to pay up unless you have information that's going to tell you this market is going to go higher. So if you keep paying up, you're going to lose money. Most people tend to pay up because they react on impulse. They see a big move, we get a slight pullback, and then they're ready to pay up. You can see that reflected here with this slight dip. You can see the market moved a little bit higher and then hit that liquidity high where we find stops and then pulled back in. So again, all the traders who are getting long paying up were ultimately trapped from the low of the prior candle at 8 a.m. So that was the London Open. They were trapped on the long side, and they got some relief, but then very quickly that rolled against them. Now this won't happen to you if you follow my first trifecta, which is liquidity. Now first and foremost, if you don't want to be executing up at these levels, you just don't, because you're paying up, prices are too high, relative to the prior day high, and it's trading what we call a liquidity area where they're likely to be stops. Again, I have a lot of videos covering this. If you haven't seen those, then you should watch those. Again, you can see we pulled back, and what now if you are a trader that is following my second trifecta, right? So that model, and this is how you gain that consistency, is that when we pull back, we're looking now, we've got demand coming out of London, which was clear because we moved higher. We also have potentially what could be supply up here from the liquidity, and also the fact the top third of this buy is likely to have a lot of sellers. So we are now trapped in between strong sellers and strong buyers. So if we want to enter this market, we want to pick a direction. We got liquidity low here, liquidity high here, pulling back into what looks like demand side in London. What do we need to see? We need to see some confirmation that this is indeed demand side. We get that at 5 o'clock, FTSE close. As we pulled back in, we see there was a slight peak in demand, and that was pretty much the highest volume we've seen for the entire day, and it was trading at a low price, which would be discount relative even to this London zone, but also relative to the liquidity low, because we've pulled back. Now we want confirmation, so we base out. We want to mark that area as demand, and you can see I've done that here, so we've marked it, and then you can see us pull back up and close above this level, right, which is the high of the prior candle. We closed above it. So now the first thing that's telling you is that this market is priming to go higher, because we've revisited the demand zone, and then we've halted, and then we're breaking back up and reclaiming it. So where do we want to execute? We can choose for dynamic execution, which is we want to, as soon as we reclaim that level, the volume's backing us up, we can get long here, for example, and then we can have our risk below the demand zone. Right, so this kind of gives you a level of now reasonable support based on orders, and if we go higher, we're looking again to liquidate back at the liquidity high, because this will be an overnight trade, right? So as soon as we open the London session, we'll be looking to liquidate that trade. So again, you can see how the market reacted to that supply area before moving back and eventually breaking through this demand zone here. Right, hence why we don't stay in the market too long when we see this. So there were lots of trading opportunities here just following my second trifecta, which is that demand and supply model. As we obviously moved lower, you can see that these levels were all broken as we moved much lower. Right, so that's part of how we build that heat map. Eventually we can see that supply built up quite heavily here, and just look at how the market kept reacting to these levels. Now, how did we add these in as well? Well, quite simply, you will be doing this all dynamically, right? Primarily just tracking the highest volume relative to prior sessions, right? So for example, again, let's just do another example. We can see that when we look here historically, 8 AM London, major session, volume should always surpass that of Asia unless there's an anomaly here, and we can talk about that on another video. But for now, we should be primarily focused on London. So we can see here we were premium prices. We can see high volume here. We can simply map this out. Demand possibly here, supply possibly here. We're unsure. We want to see which level gets taken out. You can clearly see the market struggling here. We have a breakdown, and finally, as we enter the New York Open, we take out the demand side volume, with traders paying up and getting themselves trapped, right? We know that we don't want to trade at these highs. We're close to a liquidity high. That could be very challenging. So we start to move back, and very shortly we're trading back into that demand zone. Now, you could be forgiven, of course, for rebuying the demand zone, but what you have to know is that if you've retested a demand area several times, what you want to do is get confirmation as we revisit it. In this scenario, we can see that we revisited it quite late. There was no confirmation at 6. Volume was incredibly low relative to what we'd seen at the Nasdaq Open at 2 PM. And you can see we marked this out as supply side volume. And look what the market did as it traded back into it. It traded back into that supply and then popped out again and then continued lower. So again, if you know that you've got strong supply here and the market is going into that level and showing weakness, then what's stopping you from executing a trade at the close of this bar here and then putting your stop loss just above the supply zone here, right? Again, high probabilistic trade, that this market is going to fall lower and at least trade into the demand zone, in which case you can hold this trade till the London Open, which actually came about here. We'd seen a significant reversal in Asia, but based on this drop, if you had to take profit in, you would have been quite successful, because again, I would have only traded this into the supply zone. But again, if you wanted to hold overnight and you were capable of seeing your trade into the next sessions, that's fine. Obviously, if you held it, even though you saw the market come right back to your entry, you can clearly see the reaction in NASDAQ coming back into that supply zone. So again, once you see that, what's stopping you from getting short on this trend, on these trend marks here, and then getting your risk above the supply zone? Again, the response was quite remarkable. By close of day, we were trading, we'd broken out all the demand zones that came from this day, and we were trading much lower. And this is how you start to see and understand that there are bigger players than me and they're guiding the market. So traders who will ask me about where do I get out of a trade, well, it's really simple. If you're using my second trifecta model, you want to be getting out in the supply and the demand. So you're short, you get out in a demand zone. If you're long, you get out in the supply zone. You're not trying to over push this. In this case, we're short here, you get out of this demand zone. We break through it. That's an indication we're going to go lower. If you want to hit a continuation trade on that, you can do, providing you get a similar pullback. Again, you don't want to risk being short in the hole. As I like to say, if we're significantly away from where the sellers are, then wait for it. You'll get another opportunity into the next day. You can see here that that became quite evident once we came down here, traded a liquidity low, went up, and then we started to break down to take out that level. So once again, you can see that supply forming in Asia, that struggle against it in London, and then eventually that breakdown. So again, perfect opportunity to get short on that breakdown against this backdrop. It's a new day, guys, and we can still keep going lower. So we're always paying attention and building that heat map. Now, if we fast forward to where we are currently, again, really good examples, huge breakaway on the demand side coming out of London. We kept moving higher after retesting the demand. We finally broke the supply, which again opens up a perfect opportunity for continuation trade. Again, if you followed my fourth echelon macro trifecta, you can actually see that there's some macro waves developing here, which are telling us that strong price action, big move, perhaps a very long-term move as well. That has pretty much followed through. You can see us chew through this supply as we accelerate into long-term price action. Now, again, you can clearly see those points where the market was strong. So for example, you can see the supply come in here and then we break and we close above it. Even though we struggle and eventually reclaim this level to the downside, you can clearly see that the supply here, it didn't really hold. We put in new highs. So it's now what was supposed to be strong supply is now masking as weak supply. I think we get the confirmation once we come back and reclaim the supply zone, which was here at 8 o'clock at night. That is pretty much telling you that we're going to come into a strong Asia if people are willing to close the price higher. But not only that, they were paying up much higher prices in the New York Open, and you're thinking to yourself, well, look at this, we're this high and traders are still willing to buy and create demand. Immediately, my suspicion is that we're in a longer term move to the upside. So now we ought to be careful. Of course, now we're trading extremely high, extreme premium prices. The next supply is at 25.68. At this stage now, we want to be cautious. You don't want to be paying up. Volume is very light. We've got mixed volume between 7 and 8. Clearly, traders are still willing to pay up. At some point, this is going to be a disaster. So again, anyone attempting to buy these prices is likely going to be fall victim to everything crashing. Because again, even if you wanted to be long, you should be considering demand side now at 124.30. Even at worst case scenario, reaction at 124.75. These are all extremely premium prices if we look back historically where this asset is coming from, right? So would you have rather been long here or long here? I'll let you decide. Awesome stuff, guys. Till my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct? No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?